Hello and welcome to Money Roundup.
Latest figures show that the economic recovery in Europe gathered momentum last year, continuing to surpass growth in the UK, US and Japan. Growth is often measured by gross domestic product or GDP. GDP in the Eurozone is now trending well above 2%, with forecasts expecting growth to stay around the 2% level this year and next. This is good news, but it does represent a fading in the trend rate of growth.
Improvement across the Eurozone has been ignited by the central bank stimulus policies and efforts by national governments to introduce country-specific fiscal recovery programmes. The leading driver behind the recovery has been Germany, with strong exports, low unemployment, surging tax revenues and a combination of rising real wages and historically low interest rates. These factors have been fueling consumer spending.
A data set you might not be familiar with is the City Economic Surprise Index, produced by Citibank. This measures the level of surprise relative to market expectations. A positive reading means that data releases have been stronger than expected, and vice versa. Last year, the reading was positive and trended higher, but in recent months, the index has seen a rapid decline, with the latest reading at minus 91.5.
As this decline has taken place over the last 6 months, it suggests European economies are making a weak start to the year. The decline also coincides with strength in the euro and, in recent weeks, worries about trade tariffs is thought to be impacting business sentiment.
On a more positive note, Eurozone countries will benefit from continued slack in the labour market, allowing firms to increase their output and productivity further without much pressure on wages. Weaker data points also provide information to policymakers, and these signals will encourage the ECB to maintain its strong monetary policy support through low interest rates and continued quantitative easing programme.
Recent figures released by the Office for National Statistics show UK wages rising at the fastest pace in almost 3 years. According to the ONS, earnings, excluding bonuses, increased by 2.8%, outstripping inflation, which has slowed to 2.7% over the year to the end of February.
According to Bloomberg's contributor composite forecast, expectations from analysts and investment banks point to UK consumer prices falling to 2.5% by the end of the year and 2.2% in 2019. If these forecasts are correct, then fears of further squeeze on household income will ease.
The better news on inflation and wage growth picking up comes against the backdrop of better employment data. Figures released by the ONS show the jobless rate for the UK falling to 4.2%. Unemployment is now at its lowest level in 43 years.
The inflation and wage figures this week are positive. This allows some wiggle room for the Bank of England to consider increasing interest rates, with a slight increase forecast in May. With signs of productivity improvements and an opportunity to put agreement around Brexit into place, the economy has potential to move on to a firmer footing.
Finally, US companies report their profits quarterly, and the corporate earnings season kicked off this week.
One of the important elements of the earnings season is not just the level of profits, but the extent to which they meet or beat forecasts. Earnings expectations have been set phenomenally high for the first quarter of 2018 due to a supportive economic backdrop which has gained momentum from global synchronized growth, loose monetary conditions and new fiscal policies such as tax cuts. These factors are helping to energize the US economy.
So far, while only 14% of the businesses within the S&P 500 have reported their earnings, over 80% of these have beaten expectations. Technology, financial and consumer goods companies are all doing particularly well.
The results reported have been better than expected, with profits growth significantly outstripping sales growth. The rates of profit growth we are seeing is likely to be unsustainable, as profit margins are already at high levels. Analysts will be looking very closely at sales growth to get a better sense of corporate and economic performance.
Thanks for watching. Don't forget to subscribe to the True Potential Investor YouTube channel for more of our videos.